All right, so let's go ahead and get started today. Today is Wednesday, April 6th, 11 a.m. section. Recording is on. So what we're going to focus on today is creating the reusable valuation model. So you're going to need two things. One, you're going to need to have your Nokia, I use the as is, that we finished up in our last class. You're also going to need to log into Bloomberg and make sure you log into Bloomberg with the Excel add-in to do what we're going to need to do. And I'm going to try logging into Bloomberg myself while we are talking. And what we're going to do is we're going to, in class today, basically show you how to get data from Bloomberg, update the model with a different company, and complete an as-is valuation and the other models of a different company. The class example that we'll use today is Costco. And then for Monday, your next graded homework assignment individually will be to do everything that we do in class for Dollar General as an individual assignment. Okay, so that is what's upcoming. So make sure, like I said, you have your as is, you're logged into Bloomberg. And while you're doing that, I'm going to just quickly check and see how we're doing in our Bloomberg trading challenge. So as of today, this is here, section 301. All right, so we have 3 of the 6 teams that have made their 10 longs. 3 more teams need to do some additional trades to get to 10 longs. Now you still have another few weeks to go, but all the teams are below 300,000 in cash, which is good. But based on the investments today, we can see that 3 teams are sort of in the black that made money. 3 teams have lost money. Obviously, in the last couple of weeks, depending on when you've been invested, market's been a little choppy. But again, this is kind of a point in time. It's where you're going to be, but make sure, as I said, 10 new longs over the second half of the semester. All right. So somebody said that they're confused when they log into Bloomberg. So basically, when you log into Bloomberg, you need to log in. There's usually an option that says log in with Bloomberg or Bloomberg with Excel edit. Make sure you choose the Bloomberg with the Excel add-in. Okay. And I'll tell you why in just a minute. All right. So I'm going to go ahead and open up my, close a few windows here, and share my desktop. Just because I'll be jumping back and forth, it'll be easier to see. Okay. Viewfinder, D. Nokia. All right, so this is section 301. This is our as is that we did in the last class. This is the file that we'll start with. This is our evaluation model. Okay. So what matters, as I said before, to reuse this model is this first tab on the left called the model data tab. Okay. Because we talked about before, we're sourcing from Bloomberg. That's our data source. And this is the raw income statement, balance sheet, cash flow data, row by row, that allowed us to create the standardized income statements and balance sheets historically, which were then forecasted to create the cash flow valuation. So if I'm going to reuse this model, this is the data that I need to update. And our model is set up for 6 historical years. Okay. These are the dollars, or actually euros for Nokia. And the other 2 columns that matter here are column A and column B, which is what's coming from Bloomberg. So when we export this data from Bloomberg, and I'm going to show you how to do that in a minute, we're going to export row by row all There's about 74 rows on here. And you're going to need to export these fields from Bloomberg in this exact order of 6 historical years. Otherwise, when you put the data from Bloomberg into this model, it's going to break. So it's going to match it exactly. Now, to make sure that we're exporting correctly, 2 columns instead that matter, column A, column B. Column B right here is the database field name within Bloomberg, okay? And by the way, this never changes because Bloomberg is, for the last 30 years, real Wall Street banks have been building their files tied to Bloomberg database fields because Bloomberg collects the data, stores in their database. These are the actual field names. And so everybody's tied to those database fields. And if Bloomberg ever changes one of the database fields, it'll cause chaos throughout the world. So they can't. But what they can change, and they've set up, is the ability to have what I like to call the friendly name, column A. This can change. This is just a label. This is the database field. This is the label. The label can change. So for example, if I'm looking at one company, the database field is sales_rev_turn. Here it's called revenue. For another company, it might be called turnover, right, in Asia or Europe. Now, they can change this field, be called turnover, but they'll never change this. It'll still point to sales rev turn, okay? So this is what we're going to match in our model when we export, okay? Very, very important. But it'll still export a friendly name, but this is the one that really matters. And we need a file that matches row by row in this exact order, all of these fields. Because if you don't have it in this exact order, when you put this file that you're going to export from Bloomberg into this model, it's going to break the model. Because for example, this income statement for revenue is always going to look at model data C6. So C6 has to be revenue. If C6 is not revenue, then the model is not going to make sense. It's going to have gibberish in it. So very important when you do this. Okay. All right. So back to this. Next, here's where you'll export. I'll go back to Nokia just to show you this. Nokia. All right. So working in the Bloomberg terminal, you'll go to FA. And then you're going to go to custom. This is where you can export custom data, and you'll click on create custom. That should be blank. All right. Now, what we're going to do is we're going to export and create a template that looks like this. This is the Nokia data template. Okay, that's in Bloomberg that we're going to export. The export button up here to put it into our model. That's what I'm going to show you how to do. And you'll see it'll match. There's the revenue. And there's the cost of revenue, etc. Right now, you'll notice there's 6 periods in here. Yours defaults probably to 10. So in order to export this, we're going to have to change some settings. So click on the settings button. Okay. First settings is where it says number of periods. Change yours, which says 10, change it to 6. Make sure that says 6. On the next tab over here, click on data. Make sure none of these 4 are checked. Uncheck them if they're checked, because these are extra columns in your data export that you won't want to have. We only want to have 6 columns of data. Don't want to have any additional columns. Click on display. Make sure display order is selected to be ascending. Okay, that means the most current year is on the right. If you use descending, the most current year would be on the left. Our model works from left to right. Therefore, we want ascending data. Okay, and then click update. That should get your screen to be 6 columns. Always defaults to 6. Okay. Then, so your screen is not going to look like this. Your screen, create custom, is going to look like this. It's going to be blank. All right. So our next step is we got to create a file that looks like this so we can export it. How do we do this? It's right here where it says enter field. Again, easiest way, show you 2 ways to do it, but one, I start typing in column A, the friendly name. So it says enter field, I can type in revenue. The problem is if I type in revenue, there's more than one revenue. How do I know I'm selecting the right one? There's revenue, there's net revenue adjusted, there's total operating revenue, there's net revenue. Like, which revenue do I select? So that's one of the challenges here. right? So if you select revenue and then you hover over this, a box pops up and it says in the box, Excel field ID. And the Excel field ID says sales underscore rev underscore turn. That's the database field name. That's the column B. So now I know I have the right one because I'm matching column B, sales revenue turn. Okay. Now, if I had chosen the wrong revenue, like some years it has it, some years it doesn't. So that would again have been a problem. And that's revenues plural, not revenue. So this is why you got to be careful about what you select. And because that's not sales rev turn, that if I hover over it is ARD underscore revenue. It's a different field. So because our model has to match exactly, we don't want to accidentally put that in. So I'm going to right click over that and I'm going to delete that. Yes, I want to remove that from because the second row needs to be cost of revenue. Now,
Professor,
I'm a better way.
my revenue for 2016 says 200,000.
I don't know what you're using. Are you doing for Nokia?
How do we type in Nokia for it?
Just right here. There should be Nokia FH equity. If you have a different company, it's going to be different numbers.
Oh, okay.
Because it's on whatever company that you're on. But that's actually the point. Like we're going to switch this to Costco in a minute, and this is going to populate with Costco data. But in order to do that, I'm just kind of showing you how it matches the Nokia numbers. So back to enter field, the next one down, and this is my preferred method. Don't type in cost of revenue. Take this field, copy it, go here, enter field, paste it. And then it should be the first one. Select it. Hover over to double check. See, now IS COGS 2 fee and PP and G, that's that. Okay. So better than typing it in and hoping you select the right one, copy and paste the database field and then select the right one. Okay. But I want to warn you about something, and this is the next one down. Third one is other Oper Inc. Copy. Enter field, paste. That's not other revenue. It's actually called other operating income. This is what I mean by the friendly name. Okay. So it's the same numbers. Okay. But notice, and if I hover over this, this is other Oper Inc. It's the database field, but the friendly name has changed. It's not called other revenue. It's called other operating income. That's what I'm saying. Like Bloomberg is not consistent about column A. It will change. And if you're always searching on column A, it will confuse you. So that's the point. Like focus on column B. We got to match the column Bs in the model. All right. So what I just did for these three, you're going to do 71 more times and exactly match the rest of these. All right. I'm going to warn you about something else. Every now and then, and it will happen on this list, you're going to type in one of these on column B and it's not going to find it. And you'll be like, why can't it find it? It's right there in his database field. And then you're going to go over to column A, you're going to type the friendly name and it's going to find it. And it's just a quirk of the Bloomberg tool. It's going to happen 2 out of every 100 times you do this, but it might happen on this assignment. So I'm just warning you. So if you're typing in and copying and pasting the column B and you can't find it, go to column A, type that in, and then find it. And that will actually get you to the column B. It'll get you to the right database field. I don't know why, but just warning you in advance. But as I said, you need to recreate the template after doing this and save it. Once you're done, save this template and it'll put it on this list. Now I got a bunch of templates, right? My template I called model. That's the one you're going to need individually in your Bloomberg account. All right. Once you've created and saved this template, now we're ready to export the data to Excel to update our model. Okay. So our next step will be going to export Excel current template. Okay. And so what this is going to do is you're working in the cloud. So it's going to dump all this data in the cloud here from Bloomberg to Excel. Now, I want to warn you that yours is not or shouldn't error out because I'm actually not operating the cloud. I'm operating on my Macintosh and I'm working in parallel. So I have 2 versions of Excel. I have a Mac version of Excel and I have a Windows version of Excel. You'll export only to the Windows version of Excel from Bloomberg. So you're not going to have this issue. But I want to come back to this. So save as. This is my Costco data. This is section 301. So I'm going to save this file. Okay. Now what you're going to see when you export to Excel is I'm going to open up this Excel file with my Windows version of Excel. Is my Windows version of Excel has what's called a Bloomberg add-in. See right there, opening Bloomberg. Okay. Over in the right-hand menu, you see a Bloomberg button. Okay. This is the add-in of Bloomberg to Excel. I don't have that on my Mac version. It only works on the Windows version of Excel. Okay. So this is the Windows version of Excel, the one that's based in the cloud. You won't also have it on your desktop computer. Okay. So this is only going to work on the Excel version in the cloud. But here's the reason why this matters. So this is exported all the data from Nokia. As an example, 23641 matches the 23641, 23147, etc. However, in this version that you just exported from Bloomberg, I'll click on cell C6. That number is not actually 23641. If you look up here, it's a at BDH, Nokia FH equity, blah, blah, blah. This is a database lookup. It's actually one of the coolest features of Bloomberg, because what you can do is when you export this, it doesn't give you numbers, it gives you a hookup to the database so that every time you open up Excel, it pulls the Bloomberg terminal in real time and auto-populates your Excel file with the most recent information. And by the way, we don't have to just put in this Excel model historical income statements and balance sheets. I can put current share price, share count, shares outstanding. I can put all sorts of information, option pricing, whatever I want to see. Every time I open up Excel, it just has the most recent data. And it's very powerful. And this is what a lot of people on Wall Street use. They actually work in Excel. They don't work in Bloomberg. But here's the problem. If you ever take this file and you leave the terminal environment where you're not hooked up to the terminal, or you don't have the Excel add-in loaded that loads you to the terminal, then when you open up this file, which I'm going to save on another version of Excel, so this is my Mac version of Excel, then it errors out. Right. And the reason it errors out is because on my Mac version of Excel, I don't have the Bloomberg added. I'm not connected to Bloomberg. So the second you leave the terminal, you won't be able to use any of the data. So that's actually one of Bloomberg's restrictions with their data, because they don't want you updating in real time to their data service without paying for it. So you got to actually be hooked up to their data service. So this is going to be a problem when we download the data to our local machines and try and upload or put it into our model and update the Nokia model with the Costco data. So how do I get around this? Close. So go back. If I'm in my cloud version of Excel that has the Bloomberg add-in, where it would have, sorry, make sure I load the right one. My cloud version of Excel, there it is, that has the add-in, which is the one that you have. When it actually pulls the data down, is now the database pulls. Here's what I need to do. Select the whole tab, copy, right click, copy the whole tab, select the whole tab again, right click, paste special values. So what that's doing is it's going to copy and paste. My file just die on me. Excel just crashed. All right, so back one more time. So select the file, copy, select the file, paste special values. These are now numbers. Those were numbers with Excel. Excel keeps crashing on me. So yeah, those are supposed to be numbers. Copy, paste special values, save before it dies again. Okay, now these are now numbers. They're no longer Bloomberg data field lookups. Now I can save and open the file on my terminal and I will be okay. However, I want to point out one more thing. Down here, you'll notice in this file, there's some dashes, long dashes. When Bloomberg exports the data, sometimes if it has an NA, doesn't have data in the field, instead of giving you a 0, it just gives you a dash. Okay? It just means basically a 0. They don't have it. Okay, but watch what happens over here. If I do a formula in Excel, it says pension liabilities equals this plus pension long-term liabilities, that when I hit enter, the formula errors out. So the point is Excel chokes on these long dashes. It can't calculate them in a formula and it will break our model because we can't have long dashes in the formulas in our reusable valuation model. Our model won't work. So when you copy and paste this file into your Nokia valuation model, it's going to break the model. Okay. So in order to prevent that from happening, I have to take these long dashes and turn them into zeros. Because when I turn it into a 0 and I put it in a formula, there's not a problem. Okay. So final step, get rid of that. I got to take these long dashes. I have to copy them. I have to find, paste what I'm finding, the long dash, replace it with 0 and replace all with zeros. So I can do it manually or I can use the find replace, but I got to get rid of the long dashes and make them zeros. Right? If you don't do that, as I said, when you copy and paste this into your model, you're going to have trouble. So then save this file. Right? Now I am going to open this up in the other version of my Excel, but before I do, we're actually not going to be exporting Nokia data. We're going to be exporting Costco data. So switch the company here to Costco. So now this is 6 years of historical Costco data. So same process, export to Excel, the current template. Right? As I said, this is the extra step for me. You won't have this problem, but I need to save this as Costco data, section 301. Okay. So I'm going to open it with my Windows Excel, the Bloomberg add-in, which is the one that you will auto default into. It's going to pull from the Bloomberg database all the Costco data. I'm going to select this. I'm going to copy this. I'm going to select it again, paste special values. I'm going to save this before it dies. These are now numbers. I'm going to take my long dash. I'm going to copy it, find what? Long dash, replace 0, replace all. I now have my Costco data. I'm going to save this file. Again, I'm going to bring this down to my local computer. I'm going to open it up on my local computer using my Mac version. Notice the Bloomberg add-in is not there anymore. I'm going to go to my Nokia model, the very first tab. I'm going to take all this data for Costco. I'm going to update it and overwrite all this data for Nokia. So here's how I do it. I'm going to do the same process. Select the whole tab. I'm going to copy it. I'm going to come over here to Nokia, select the first model data tab, select the whole tab, right click, paste special values, and that will update row for row, number for number. The 6 years of historical data is now Costco in my Nokia valuation model. I will then go to the CFI and I'll do a quick check. My CFI should balance. All right. If my CFI doesn't balance, that means I had a problem with my data export. Okay. which means I didn't get this right. I didn't put in the right fields. I didn't put in the right order. I got something out of line here because otherwise everything should balance for your assignment. Okay, so that's the point. If I go back and CFI and it doesn't balance, is my TII or TFI out of balance? Because that'll tell me at least where I likely messed up on an income statement or a balance sheet item. But the point is, you should have a balancing model, okay? And everything should work when you export this way. All right. So now I'm going to file, save as my Nokia file because I want to overwrite that. So instead of the Nokia as is, this is going to become the Costco as is. Yeah, this is section 301. Let's see, this is my Costco directory.
Professor, will the TAs have a copy of your of this worksheet that you're
They will later today.
Okay.
Yeah, because I have to send them everything we're doing for the Costco and the Dollar General models. But yes,
Okay.
they'll have the Costco and the Dollar General models later today. So back to this, but they already have the exported version. Because they did this last semester. But long story short, as students, because the TAs were previously students in this class. All right, so back to this Costco model. I now have the Costco data historically. And if you remember in our model, the next tab over, assumptions and ratios, we're going to be key to the valuation, right? But remember that right now that these are Nokia's numbers. This is Nokia's WACC. This is Nokia's G. This is Nokia's share price. This is Nokia's share count. This is Nokia's revenue and EBITDA. These are Nokia's multiples. They're not Costco multiples. These are Nokia's ratios. So that's why we use the concept of yellow cells, because I have to update these yellow cells to make sure that they more representative of Costco. So first thing, check my last reported year. Is it still 2021? Look over here. Right now it is. If it were 2022, switch this to 2022, last reported year. Okay, still the same. WACC. Now I need the WACC. These are where the 3 screenshots come in. Okay, so I'm going to go back to Bloomberg and I need my 3 screenshots. First, I need a WACC. So take my WACC, right? Costco's WACC is 8.2. It's not 9.3. So take my screenshot, save, Costco, WACC 301, section 301, save. All right, so I'm going to come in here, change this from 9.3 to 8.2. Okay, next I'm going to need my DES and EEO. Notice that Costco's share price is changing. That's going to change the multiples. So I need to do my DES and EEOs at about the same time. So I'm going to do these very quickly in succession. DES, file, take screenshot, save. Costco, DES, 301, save, EEO, file, take screenshot, save, Costco, EEO, -301. Okay. So here's the point. If I go back to my screenshot, because the price keeps bouncing around, 579. Okay. So I'm going to go ahead and put in my share price, $579 a share. Share count's not going to be the same. Back on the share count right there. Shares outstanding for Costco are 443.2 million shares. So shares outstanding, 443.2. Okay. Finally, I need my EEO, still on that screen. These are not the revenue and EBITDAs for Nokia. So I need to update those as well to match Costco. So for example, in 2022, the revenue for Costco is expected to be 220.29 billion. So 220,290. $236,826. 236,826. For 2024, 252,700. And for 2025, 269,894. 269,894. For EBITDA margins, EBITDA in 2022 is 98.74. 98.74. Followed by 10,884. 10. Followed by 12,106. Followed by 13,194. Right? The multiples, that's why the screenshots were important. EV to revenue, 1.07, 1.01. 1.07 and 1.01. And then the EV to EBITs are far different than Nokia's. 29.11 and 26.49. Okay, so that's giving me a perpetuity EBIT, operating margin of 3.7 and 3.8%, much closer than the two numbers for Nokia, so a much tighter range, right? But nonetheless, I have my perpetuity EBIT margins. Now I go to my ratios. Again, these were Nokia ratios. The first one is balance sheet ratios. Now we didn't really change any of these balance sheet ratios. We just left them constant. And by the way, if I unhide here, you'll see that the invested capital to sales multiple 10 or 11 cents stays at 10 cents to perpetuity. So I don't really think I need to change Costco's balance sheet assumptions. I think those are fine in perpetuity because these seem to be pretty close to those. And for most companies, you'll probably leave those alone. And by the way, notice that my current share price and my model share price are already getting pretty close to each other. Okay? But I still have the income statement assumptions, particularly tax rate, EBITDA, growth rate, tax rate, that 25%. And again, I'm going to start hiding these again, just so it's easier to see what I have. Let's see here. That 25% tax rate is Nokia's tax rate. It's not Costco's tax rate. So I need a Costco forecasted tax rate. Okay. So it's at three areas. One, Costco, GUID. Does the company give guidance for tax rate? Costco actually does. Okay. Last reported, they said a range 26 to 27%. Long-term 26.5%. There's their guidance. So 26.5. And that's going to update all the years. And again, the perpetuity year is the most important for our model. Now I'm getting really close to the share price, but that's a problem because I have the wrong EBITDA margins. Those are Nokia's EBITDA margins. And that's what I mean by we're still reusing this Nokia model. So anything we typed in, hard coded, still exists. We're going to be very careful about that because that could cause problems with our valuation. Because Costco is probably not going to shrink by 20% and see their margins grow to 17.5. Like that's just probably not realistic. So what I like to do is reset. So I'll take cell L7 equal to previous year. And just copy and paste that over one. Take cell L3 equal to previous year. Just getting rid of the Nokia data that I hard coded in, at least set it to a baseline. Okay. Now, this is going to drop the share price to $218, but nonetheless, I'm at least closer, right, to a more realistic model. Now, back to this EBITDA margin. This EBITDA, we know should be driven by this operating margin of 3.738. Now, because these are close together, and historically it's been closer to 4, I'm going to choose 3.8. But here, that's the number that needs to be 3.8, right? Based on what we did last time. So remember, I can't change that. That's a white cell. So I'm going to make that 3.8 by making 4.947. So EBITDA margin fall to 4.7% in perpetuity. Give me an operating margin in perpetuity, 3.8%. That's now at a $209 share price. You still got to get to 579. All right. Now you might say, gee, most of these numbers are loaded in. Why might we be so far off in the share price right now? And that's because when we go here, the two last assumptions are G and growth. And remember when we did Nokia wasn't expected to have a lot of growth in perpetuity. Okay, we talked about that last class. That's not Costco. If you look at Costco's EEO, Costco revenue, they're growing, even at scale. They're growing dramatically every year, high single digits. So the point is, unlike Nokia, Costco is expected to grow. So that G is obviously way too low and we're going to need to solve it. So we need to go down here and figure out a more realistic G. Because like I said, at that G, we get a multiple of 9 times earnings. They're trading at 29 times earnings. So we clearly need a much higher G. Okay. So how do we put in a higher G? Well, if you've ever done an IRR in Excel, which is basically what we're kind of doing here, you'll notice the formula for IRR is IRR value range guess, right? And you probably don't ever put in a guess in IRR. But back in the day, when computers were far less powerful, when you, and the function still exists, is that when Excel solves for an IRR, what it actually does is it starts with a number and it just keeps iterating until it solves. So that's the whole point of a guess. You're telling Excel where to start, and then it iterates around that number to get closer to the number. Now, as I said, because computers have gotten so powerful, you don't really need to do a guess anymore, and Excel can just go almost instantaneously through millions of permutations and solve your number, okay? But back in the day when computers were less powerful, we had to put in a guess because Excel would take longer to get to that solved number. So you had to give it sort of a starting point. Well, that process is similar to where our model is. We're going to solve for a more realistic G to get this model EBIT. The problem is we need a somewhat realistic ROIC in perpetuity to get a realistic G. And at 0.5%, we're probably not going to get a realistic G. So therefore, or a realistic ROIC. So therefore, what I need to do is I need to at least start with a more realistic G. We'll call it 3%, right? And then I'm going to come over here in my model, share price started to go up, right? And then I'm going to solve for the G that gets the multiple. And then the reason I'm using 3%, I just want to go back over here, is Nokia is expected to grow. So unlike, or sorry, Costco is expected to grow. So unlike Nokia, I want to actually start with my guess G to say 2 to 3% is what most mature companies grow with the economy. I think that's going to be Costco longer term, not 0.5%. So I'm at least going to start with the 3. So here's the point. Now I come here and I want to solve for the G that makes this 29.11 down here. Okay. So I clearly know it's not going to be 0.5%. Watch what happens if I make it 3, 12. I can make it 5. Now my multiple goes to 18. Let's go to 6. Let's go to 7. Okay. Somewhere, and I can keep iterating through, that's 46, to get to this multiple. Or I can use the solver, which we talked about in the last class. So data, what if, goal seek. So I want to set cell C22 to the value of 29.11. I want to match that multiple by changing a G, which was C21. So I'm just going to let Excel do this for me rather than keep iterating. But the answer is 6.23% is the G that makes them work. So I'm going to come over here, cancel. I'm going to make my G 6.23%. All right. So when I did that over here, notice my share price is now back up to around $560 a share. I'm pretty darn close. So the last number I want to adjust is just the revenue. So instead of 7%, what if it were 8%? 8 and 8. 9. So maybe 9 and 9. Maybe 8.5. 8.7. 8.7. Pretty close. Somewhere in that range. There is my as is for Costco. And that's the process to get there for that we worked through Nokia, just applied for the Costco model. Questions? Questions about anything I did, how I did it, why I did
Yeah,
it?
I have a question. All of the white numbers and the assumptions and on this page are the historic ones. Are they Costco or are they the prior Nokia numbers?
Well, let's see. I'm gonna unhide this. Okay. So you see all these white numbers?
Yep.
Costco. All right, I'm gonna open up my Nokia as is. And I'm gonna go to the ratios and unhide.
Hmm.
And the reason why these white numbers have changed is because we changed the model data. Because the ratios are based on the historical income statements and balance sheets of each of these companies. And so when we reloaded the Costco data and overwrote the Nokia data in the model, everything funneled through. The income statements got updated. The balance sheets got updated. Therefore, the ratios got updated. That's the beauty of all those white cells.
Okay, thank you.
Sure. But that's why I want to reiterate why I don't want to accidentally type in a real number over one of these white cells. Because if I make this 22.3, then that's not going to ever update. It's just going to always be 22.3. And I'm going to have a weird anomaly in my model. Like something looks amiss here. Don't know why, because I hard coded that. So that's why I don't want to hard code a number. Let me undo that. So accidentally leave that in there. Okay. But that's why I'm talking about how you break a model. Other questions? All right. So I've finished my as is. I have 3 more Excel files to go. So the next file I need to do is my bull and my bear, and then I have to get to my target. So file, save as, Costco as is, rename this my bull, save, and then I start putting in my bull assumptions. Now, in order to do the bull assumption, I would have had to do a little bit of EIC. So at a minimum, go to BICO. Here is at least the summary of key points that the analysts are talking about for Costco. That'll help me with my bull and my bear. Go to industry. This is the industry primer. This is going to be the discount retail staples industry. So this is going to help me the industry issues that are going on with Costco. I could also grab an IBIS World report, but the point is I need to have some context to do my bull and my bear, just like we did with Nokia. I read it, understand it, put in my bull and my bear assumptions. So I'm clear about why I'm putting them in. So I've established my range, file, save as target. Where in the range do I think that they're going to be? Create that price, check against the current price, create my buy, sell, hold opinion. Okay. And by the way, if you want, you can also look at the analysts just to get a sense of where they ended up, because you get a sense for their target prices. That might help you as you even start to think about the ranges for your bulls, your bears, and your targets. But the point of the story is you have to create those 4 files. You have to submit as part of your assignment 4 Excel models, your as is, your bull, your bear, and your target. You have to submit the 3 screenshots, the DES, the WAC, and the EEO. And you have to submit a paper of a minimum 500 words that explain your assumptions and why you're changing them across the 4 models. Okay. And so what are the 4 models? The target, the bull. So I'm in my bull file. Why did I change what I changed between the target assumptions and the bull assumptions? I left the balance sheet alone. I changed the tax rate, left the tax rate alone. I changed the Ebitda. Why did I change the Ebitda? Why did I change any of the growth rates in my bull model? Did I change my G? Why did I change my G? There should be a rationale in the real world business. That's why it's important to do the EIC first. Okay. So this is all part of your upcoming assignment. The only difference is your upcoming assignment due on Monday is to do all of this, not for Costco, but for assignments, homework 8, Dollar General, DG US equity. So individually using these files, So I'm not going to do the bull, the bear, and the target unless somebody really wants me to. Okay. But basically, you're going to do what we just did, export the data for Dollar General, create an as is, a bull, a bear, and a target, 4 Excel models. You're going to create 3 screenshots, DES, WAC, and EEO in rapid succession. You're going to write up your assumptions across the 4 models that you're changing. You're going to do that in a minimum 500-word paper, and all 8 of those files are your next homework assignment. This is a big assignment. I also want to point out that this morning I changed the assignment. Down here, it's worth 5 points. This is 5% of your semester grade. Okay. As of this morning, it was only 3% of your semester grade. I added 2% of your semester grade to this assignment. But what I did by doing that is I created the first extra credit opportunity of the semester. So heretofore, there was only 100 total points available this semester towards your grade. As of this assignment, there's now 102 points available towards your semester grade. So there's an extra 2 points in this assignment, if you do well, of essentially extra credit. So for those of you that were struggling on any previous assignment or midterm or your group projects, and you're like, is there an opportunity for extra credit? This is one of the few extra credits I'm going to give you this semester. Okay. So this is now a 5-point assignment, not a 3-point assignment, and 2 of the points are extra credit, right? But it's a big assignment because you have to create all these models, do the write-up, do the screenshots, follow all that process, make sure you turn that in by Monday morning. Okay. And your company is Dollar General, which means you're going to come in here. You're going to go to GG, US Equity. You're going to go to FA. You're going to take that model template that we just created, or you were creating, or will create under custom. Should be there if you've saved it. Take your model template. Okay? You're going to export this template to Excel with the current template. When you export it to Excel, you're going to get rid of the dashes. You're going to copy and paste special values and turn these into numbers. You're going to then copy and paste this into either your Nokia model, or if you were following along in class, you could do it with your Costco model. Costco Excel. Okay. All right. So you're going to take this exported data, which will be Dollar General. You're going to come to this model data tab. You're going to put it in here, cell for cell, row for row. You're going to check your CFI to make sure it balances. Right? Then you're going to come in here. You're going to update the assumptions with the Dollar General assumptions based on your screenshots. You're going to update the ratios based on the Dollar General ratios based on the screenshots. You're going to come in here. You're going to solve for your G. Based on that G, you're going to update the revenue to get the share price within $1 of Dollar General share price. That's going to be your as is. Once you get that file, you're going to save as bull, save as bear, save as target, changing the assumptions. And then you're going to go to a paper, and in Word, you're going to write up those key assumptions. Why did I change revenue growth rate? Why did I change EBITDA margin? Why did I change, if not, tax rate? Did I change anything here about the G? And why did I change the G? Or did I change anything else? Like when we changed Nokia, we changed the revenue EBITDA. Like, what did you change? Why did you change it? What's your business rationale? So you'll need to do a BICO. You'll at least read the BICO. You don't have to turn in a BICO, but you need to look at the BICO and look at the industry primer for Dollar General. Because if you don't know a lot about Dollar General, you need to have some basis for why you're changing those assumptions as you create your bull, your bear, and your target. That's your assignment. That's due Monday. Somebody referenced the TAs a few minutes ago. TAs will have office hours the next 2 days. If you're struggling with any of this, take advantage of that. Okay. They'll have copies of these models. We're not giving you copies of these models. You have to have created this yourselves. Okay. You have to take the screenshots yourselves. These are individual files, individual models. Okay. All of this due 7 a.m. Monday. Okay.
Did you say
So-
we need to, in our write-up, explain the as-is values as well, or just the other thing?
I would say you just have to refer to the as-is values. I put in this WAC, I put in this G, I put in this, etc. And then I would say you're really explaining the differences in the other 3. But at least reference the as-is and make sure you use numbers when you go through that. But really it's changing. It's like in the as is, we got a G of 6 point something percent for Costco. Let's say in my bowl, I use 7%. Why'd I go from 6 to 7 in my bowl? Maybe in my bear, I went to a 5% G. Why'd I go from 6 to a 5? Right? What caused me to make that change? That's what you're writing up. So across those, I'll call it 5 key assumptions and any others that you think you need to change across those models. That's what you're going to have to write up and explain as you go model by model for Dollar General. By the way, 2 weeks, you're going to be doing this as a group project in your next presentation. And that's the difference. In your presentation, you'll have all these files. The difference is it'll be a 10-minute verbal presentation on a company to be named soon. Okay. But right now, this is individual, but group projects coming up very shortly on these as well. Peter, you had your hand up?
Yeah, the ratios. On your example, you said you didn't change a lot of the balance sheet ratios, but when you pull up a different company, I mean, like some companies going to be receivable heavy and that sort of thing. And I mean, should we worry about that stuff?
Well, worry is an interesting word, but yes, technically yes. But here's the point. If I'm sharing my screen again, this is the Costco as an example. The part that you should be worried about is row 24, because row 24, start out on the left, that's the historical IC to sales ratio. Remember when we did our ROIC tree, that was these numbers. Okay. And so here's the point. What I want to make sure of is that when I do a forecast, that I forecast a reasonable balance sheet. And we're using this to say, okay, this is the level of balance sheet to sales. Should my level of balance sheet to sales in the future look similar to the past? If it looks similar to the past, you're basically saying that, you know, a lot of the business is not going to change too much. Like it's just kind of repeating what it does. That's true for most companies. So as long as these numbers look pretty close to these numbers, I probably don't need to worry about these ratios no matter what they are. However, if these numbers look far different, like let's say this is 0.1 and this is 0.2, well, that's saying I might have to change these ratios to be more representative. Or let's say Costco announces that they're going to do a major restructuring. They're going to get rid of all their stores and go 100% online. Well, then net fixed assets, I'm not saying they're doing that, but then net fixed assets as a percentage of sales are probably not going to stay at 13.5% in the future. Like I'd have to change that to be more representative of an all online Costco in the future. So I'd have to put in a more representative net fixed assets. But for Dollar General, you probably won't have to deal with this and you can probably leave the balance sheet alone. But as I said, if for some reason you think you need to change it, you have the ability to change that.
Okay, thank you.
Sure. So as I said, I wanted to focus you. That's why I called it the 80-20 rule. Here's the most important things. Growth, EBITDA, tax rate. That is the 80% of your valuation because that drives the gross cash flow and that will change because that's going to be revenue margin. And that's why we focus most of our time as analysts there as well. It's back to our DCF. What we're trying to do is it's all about forecasting the free cash flows, right? So what's going to drive that free cash flow differences? Because that's how the share price is going to change. If we're not changing the non-operating values, the model's focused on here. But even in Costco, look at this. The first 5 years, year by year, don't matter that much. That's only 20 billion of their operating value. Costco is all about the perpetuity. What's going to matter most is, do I have my perpetuity ROIC right? And do I have my perpetuity G right? That is the 237 billion. That's why we got to get a reasonable G, okay? And we need a reasonable ROIC in our valuations. That's what's much more important to your model if I'm doing a Costco than the year by year changes here. Okay? And you kind of see that over here in the DCF tab. But nonetheless, that's the process that we're kind of following for all these companies. All right, so again, this has been recorded. I will be posting this on YouTube very shortly. TAs will have copies of this. Remember, take advantage of their office hours. See everybody on Monday. Have a good and safe rest of your week.